Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day everyone and welcome back to the Family Finance mini-series where we discuss the grey area of families and money. My name is Mitchell Sneddon from the Rask Group. I'm here with my good friend Phoebe Kohler from InvestSmart, and of course we're joined by Siobhan Ashby from Northeast Wealth. Guys, talking about grey area, we're about to really get into the grey area with future-proofing your finances.
This is controversial.
When I hear this, and in the pre-chat that we just had, we all immediately went to divorce. but future-proofing yourself isn't necessarily just about divorce. Is that right, Siobhan?
Yeah, of course not. I mean, divorce is very prevalent in our society and it remains that way. But future-proofing is against so many different things, whether it's death, serious illness, of course, family separation, even,
job loss,
absolutely. Wage growth commensurate to inflation, parental leave. There's a whole host of things that you need to think about.
When you're working with clients, what are like the top things that people are referring to though? Is it life after separation? Is it, insurances, I'd imagine, would be a big one.
Yeah, personal insurances is a really big one and often overlooked. It always sort of sits in that important but not urgent category. A bit like estate planning, wills and powers of attorney. You think, oh yeah, that's valuable to have, but not right now. So the interesting sort of perspective with personal insurances in particular is that, a lot of people might have a car that's worth arbitrarily $20,000 or even let's call it $50,000, and they would not drive out of their driveway without that car being insured. But if you consider yourself and your capacity to continue earning an income, you are your greatest asset. And, the average income in Australia is near $100,000 at the moment. Let's imagine you had a machine sitting on your bench that spat out $100,000 every year. Are you going to insure that machine?
So I've never heard anybody say it like that. And I was going to ask you, should I get insurance? I don't have insurance.
Well, that's financial advice that I'm not going to delve into. This is general in nature.
Very good thing to say.
But it's a really, really, really important consideration because a lot of people don't have a lot of money in the bank and a lot of people don't have stacks and stacks of leave available. So, if you get sick, what are you going to do?
What insurances do you mostly see your clients actually have from that personal perspective then? Is it the life and TPD? Is it the income protection insurance?
Good question. It really depends on your stage of life. For example, if you're younger, like the two of you are young parents, you've got young children. Welcome. Young children, mortgages. So if you guys died, you're leaving behind a situation where if you didn't have life insurance, for example, your homes might need to be sold to clear the mortgages. And so that puts your spouse and your child in a really precarious financial position. That's life insurance is quite useful for younger people in those sorts of situations when you're leaving behind things like a debt and financial dependence. Total permanent disability, that's the TPD that you were referring to. That is a good one to have, but to be fair, it's a pretty extreme scenario where you are disabled to the point where you can never work again. It's certainly valuable to have the cover if you find yourself in that position, but statistically, it's a low claimed upon cover. So statistically, the highest ones that are claimed on are income protection and critical illness cover because those ones are more common. So income protection is paid if you can't work for a period of time due to accident or illness. So you might not even get really sick. You might be in a car accident, for example, or you might be sick but not disabled forever. But you might get cancer. You might have a heart attack. Those illnesses are quite common in Australia these days. So those are the ones that are are often overlooked and can be really valuable.
So when you're sitting down and talking future proofing with families, it's number one is let's check out the insurances.
Yeah, I think so. Because it's just sort of I've seen this play out in a couple of scenarios. Personal insurance can often be looked at as something that, oh God, it's just a cost, and these insurance companies, they're not going to pay me anyway, which is actually a massive misconception, particularly if you have personally underwritten insurance. So there's, you can have insurance within your super fund, and a lot of people rely on that and think, oh, I've got cover. More often than not, it's an inappropriate amount of cover. If you apply for personal insurance, you have to go through medical underwriting. So you have to tell them what your history is. And yeah, you might get declined if you have a string of things wrong with you, but also a lot of people get accepted. And so they can't then not pay you unless you did a fraudulent application. So you're covered if you get sick after that. So essentially, those premiums will be something that you pay and never need to claim on, because if you don't need to claim on them, you're lucky. You've got good health and those sorts of things. But if you do need to claim on it, no one ever regrets having the payment come through when they need the money. And I've seen scenarios where there was a member of a couple who had a young daughter and a big mortgage, and he passed away pretty suddenly. And he only had a standard default level of life insurance within his super. So wife was now widowed and left with a young daughter, like 1-year-old, and a mortgage. Some of the mortgage got covered, but wife was forced to go back to work pretty quickly in a really emotional, awful time, worst time of her life to, keep the lights on. And that is a really shocking position to find yourself in versus I've had clients who have been diagnosed with cancer. Now, that's also not a good position to be in, but fortunately they were okay, it was caught early, etc. They got a $200,000 payout. And that was a huge chunk of money that they could put towards their mortgage, take 6 to 12 months off work to recover, go on a holiday. So if you never need to claim it and you do just pay for the premiums, you're actually in a fortunate position. And insurance premiums, or personal insurance premiums, some of them can even be funded from your super. So you don't even have to sort of bear all of the cost out of pocket. So I think that's, they're not for everybody, but I think that they're worth considering, particularly if you're younger with young kids and debts.
How would you go about considering it? Like, how would you go about checking into it? Like, is there, do you jump online? Is there a few like, hey, do you need to
have an advisor to get these kinds of insurances?
Often people go to advisors if you want that higher quality cover. You can just apply through your super fund to increase your cover. You can't get all of it in super. For example, with total permanent disability, there are different definitions that are applicable. And if you want the good definition, in my mind, you need to apply for that. I think there are some insurance brokers that might do it, but generally it's something that you would get through a financial advisor. And there are financial advisors, very good ones, that only do personal insurance. So it's not like you have to go through the whole financial thing if you don't want to. You can specifically go to risk-only financial advisors. Yeah.
So let's get into the grey area of divorce and separation, because that's where we immediately went to, and all the, our eyes lit up when we started talking about this subject, because divorce it happens. Like, people go into relationships, and not even just divorce, I should say, like separating from a de facto relationship as well. Of course, you go into a relationship with all the intention that this is going to last forever.
Well, hopefully you do.
Hopefully, yeah. Well, if that's not you, write in. We'd love to hear about it. But of course, you go into this thing like not expecting to come out divorced. Now, I know of the last 5 weddings I've been to, 2 of them are already divorced.
Absolutely, we're hitting divorce time.
And people change. Like, if you met your partner when you're in your early 20s, and by the time you're in your 40s, you could be two very different people, or the kids have grown up and left the nest. You're seeing grey divorce pick up dramatically because you all of a sudden turn around and you don't have the child there that you've fixated on for the last 18, 19 years. You go, shit, what are we going to talk about now?
Not to mention different parenting styles and all sorts of reasons. Like just because you get married to somebody doesn't mean you know how to parent that child with them.
Totally.
Yeah.
You can have completely different values and not even realize it until a situation like that arises. Yeah.
So do you deal with – so how do you plan for something like that, like a separation, when you don't actually plan for it to happen? That sounds weird. How do you plan for something that you don't plan for it to happen?
So I think that this is important. I'm going to generalize here, but important particularly for women to consider, because I've seen this happen a lot, and it's just common in society. You know, you have children and the woman tends to be the primary caregiver. So she might take a step back from her career or even just be a stay-at-home mum for 5, 10, 15 years. Now, that's your choice if that's what you want to do. But the risk of doing that is that if you separate from your partner, not only, often then those women that were the primary caregiver stay the primary caregiver, so you have to bear the most financial cost. You might not have a partner who pays their child support even though they're supposed to. And also from a career trajectory perspective, your income is likely to be really low because you've not been in the workforce or your wage hasn't been growing commensurate to even inflation in some cases. So I think that it's important to just that is a way to future-proof yourself, is to keep your career growing. I know that that's not for everybody and I respect that it's not for everybody, but the alternative can happen where I've seen women. I had a client who was in her 40s and she had 3 young children. The oldest one was in prep, so really little kids, separated from her partner, and he was not a particularly nice person, so he didn't help her out financially. And she was a school teacher earning $60,000. And it's like, how do you afford that? How do you get by? It's awful.
I don't know the answer to that.
Yeah. She was fortunate. Well, I say fortunate lightly, but she received an inheritance. So obviously someone had to die to receive that, which is not fortunate. But she had a lump sum in the bank, which was really helpful.
Yeah.
But that's anomalous. That's not normal.
But it's also not necessarily what she wants to spend that inheritance on.
Exactly.
You know, you kind of earmark inheritances for big things, not to live your life.
Yeah, survive.
Yeah.
Yeah.
That's right.
Okay, so people move on from divorces. Say you're living your life and you come into a new relationship. You've had this experience. How do you go about potentially protecting your assets and future-proofing your assets then?
Yeah, that's really common. We see a lot of that. People that meet in their mid-40s, 50s, 60s, and they already have this accumulated asset base. They might have already lost a chunk of it in a previous separation, so they're very, focused on not losing it again. That's where it's really valuable to have some solid estate planning in place and utilizing structures like trusts. If you have something like a family trust, for example, you can hold your assets in a trust and it really safeguards that from a fresh separation, because you might have children that you want to leave your remaining assets to if you die, for example. I see that often as well, is that two people meet maybe in their 50s, they have their own accumulated assets and they also have adult children. It's like, if I pass away, I actually want to leave my money to my kids, not to you or to your kids. So having wills, having powers of attorney, being very explicit on where you want your money to go if you pass away, but also, while you're living, having structures like trusts in place to ensure that there is that separation of the ownership of the assets.
Who would you would go to an advisor to set up the trust, or would that be done through, say, a lawyer who specializes in estate planning and whatnot?
Bingo. You'd see an estate planning specialist that would help you. And don't get me wrong, the estate planning specialist just helps you with the setup of the trust. If you wanted, any recommendations on what sort of investments to have, that's when you get to a financial advisor. But the setting up of all of that is through an estate planning lawyer. And that's actually a point that I think is important, is to use the services of an estate planning lawyer. That's something that remarkably people think, oh, I don't want to spend that money, so I'll just get a will kit.
Well, yeah, I just thought an estate planning lawyer was for when you
When
die.
you die, yeah.
Yeah, it's for all sorts of things. Intergenerational wealth transfer, power of attorney. So what happens if you just become, physically or mentally incapacitated? So there's a whole host of things that estate planning lawyers help with. And particularly when you're in a blended family situation, that can be super valuable. Well, not even particularly when you've got young kids as well. You want to make sure that they're taken care of, right?
Can you change your mind and add new people to those trusts?
Yeah, absolutely. You just need to go and refresh it. But that's actually another thing that I've seen. I saw this really recently. I was a couple who have had previous marriages, and I was reviewing their whole financial picture, and I looked at the beneficiary nomination on her super, and it was binding to her ex-spouse.
Oh.
And so a binding nomination in super, there's two types of
tell me what that
nominations.
is.
You can have binding or non-binding. So if you have a non-binding beneficiary nomination in your super, it's me basically saying, I would like my husband to have this, but the trustee of the super fund has the ultimate discretion over whether or not that would get paid. So it leaves it open for contestation. Contestation, is that a word? Just
To be contested.
To be contested. There we go. Thank you.
Sounds good.
Thanks. But a binding nomination is what the name suggests. It's binding. So the trustee of the super fund has no discretion to override that. So that's where people can get caught out if they don't check on the nominations of their funds. Because if you've had a binding nomination to your ex-spouse and then you separate from them and you don't want it left to them, you want it left to your children or to charity or whoever, if it's binding to them, it gets paid to them and there's nothing that anybody can do.
You can't change a binding nomination.
You can change a binding nomination, but a trustee can't override a binding nomination. So it's up to you to go back to the super fund and say, I want to change this now. Yeah.
How much does it cost to establish a family trust and keep and maintain a family trust?
Look, in terms of the cost of establishment, it really depends on the solicitor's fees, but I believe it's somewhere in the sort of $1,500 mark. It doesn't cost anything to maintain a trust.
So you don't have to get like an audited each year, like an SMSF or anything like that?
Well, it depends if you have assets in the trust, of course. Usually a trust would have to do an income tax return. So where I was going with that is that for the trust itself, it just sits there. It's not the cost of the maintenance of the trust. It's more the professionals that you need to engage around it to help you with it. So it's more the service fees that you'd be paying to those professionals, which is usually accountant, financial advisor.
In your line of work, how many people come to you initially and don't have a will?
Most. Do you guys have wills?
Do you have a will?
Do you have wills?
I don't. No.
No, I don't.
I'm going to be sprightly,
Yeah.
Got to be kicking around when I'm 90, surely.
This is everyone's assumption. And look, hopefully you will, mate. But,
look, there's maybe some lifestyle decisions that say I might not be. But
No, my will is me talking to my sister saying, so you're going to have the kid, right? That's it. And she's like, yeah, okay.
even if Lee's still alive?
Yeah, that's right. Oh, Lee, Captain Sensible. Hey, I'm surprised. I'll have to have a chat to him.
But that's the other thing that can make it really tricky as well, is that you would have like natural inclinations of what you want to happen. But that's not necessarily the way that it would pan out from a legal perspective. And even if it does, it can be really, really, really hard on the person who's bereaved because they've lost you and then they're responsible for your estate and they have to be in the courts and like fighting and trying to get it all organised. It's caring to them as well to just have it set out.
So tell me, I want to get a will, Siobhan. How do I do it?
Great. Go and see an estate planning lawyer. But first, before you do that, I'd be just having some really robust conversations with your partner to say, what do we want to do? Like, where do we want to leave our things? Because, of course, the thing is as well, when you've got children, you've got a 3.5-year-old, you're not just going to say, have the assets. There's probably going to be, you just mentioned your sister. You might have your sister being sort of a guardian of the assets until your daughter reaches 18 or 25 or one of those sorts of things. So you need to first have the discussion with your partner, I would say, and think about what happens if one of us dies, what happens if both of us dies, but then also go to an estate planning specialist and get it implemented.
Okay.
Great. My work here is done.
No, you have a kid and then you're bombarded by all of this stuff you need to do. And really, in the back of my head, a big one has been will.
Yeah, well, I see it's the important, not urgent category.
It is the important. It is very much that.
The important, not urgent category really fills up quickly.
It really does.
Totally.
It really does. Yeah.
What else is in that important, non-urgent category that you find people put off?
That's a really good question. Dealing with your super and investing that appropriately. And that is another sort of future-proofing thing to do as well, because people often think about their superannuation as just, it's so far into the future, it doesn't even matter. But actually, statistically, outside of your family home, your superannuation is the largest asset you're ever going to have. So what happens to that money and the effect of its growth and the compounding interest that it makes is a future-proofing situation, because you might as well have your money working for you rather than you working for your money. And the earlier you get your super invested into something that's appropriate based on your risk profile and also your age, if you get that set up in your 20s or 30s or 40s, for example, and just let it run for a while, that's going to have a really substantial impact to your wealth when you're retired. And if you do find yourself in that situation where I've just separated from my partner, well, having more money there in your super is going to really help you when you're older and single.
So I need to tell a little story about this.
Oh,
please, if you would.
Please, I'm intrigued.
I think it's really important to take ownership of your super. I'm not somebody who is totally financially literate, as much as I would like to be more. I sat down in preparation for this to have a look at my super, and I discovered that my 20-year-old super fund, super balance, which sits as one of the big industry ones, has been in a conservative fund for 20 years.
Oh, no.
Yeah.
Wow. There you go.
That's because that was thoroughly in the category of important,
not urgent.
Because it was important and not urgent. And I thought, you know what? I'm taking steps to have better financial hygiene. I want to take control of this. I'm doing this, and I'm going to pay attention. I'm going to get a will. And I discovered that my super balance, which isn't very much, has been sitting in conservative. So I switched it over to high growth in the hopes that the next 20 years might go better.
Well, that's and so the funny thing is, so I know what you do for work, Phoebe. You'd be talking to people and setting up accounts for their SMSFs and things like that on a daily basis.
That's right.
But we just sit here and you don't think about yourself.
And I guess what I said earlier. I am financially literate, but I don't apply it to my life as much as I should. It's a bit of the interior designer has a pigsty in her front yard. In her front room, but certainly that was a shock. I was really shocked because I assumed that when I set it up, it would have been in high growth, but sadly it wasn't.
That's the thing. Like, even if someone was, say, you get a 20 or a 30-year-old or a 40-year-old come along, and they are an ultra conservative person, they wait for the green man before they cross at the light. So every single time does not mean that they should be in a conservative superannuation setting. It's I base I base things predominantly off time frame. The longer you've got to invest,
certainly,
and you focus on that time frame and align yourself with an investment portfolio that suits that investment time frame. So in a high growth portfolio, you've got more time to recover from the ups and downs, and you've got more of your assets then work in Australian shares, international shares, etc., compounding and funding your future lifestyle. And so I think, even if you are a incredibly conservative person, have a look at that, and there's every chance you're doing yourself a disservice by staying in a traditional conservative portfolio.
Well, certainly I was. And that change took 15 minutes.
Yeah.
You know, it wasn't a big deal. It wasn't a big deal to check on it. It wasn't a big deal to make the change. What was a big deal was it was in my own head. I made it a big deal because I didn't want to do it.
Yeah.
It wasn't.
And that change might be the difference of tens or hundreds of thousands of dollars over 20 years.
Absolutely right.
So, you know, something that the worst time to prepare for your retirement is when you want to retire. You know, the earlier you think about it, and I'm not saying we need to sit down and make a retirement plan, but the earlier you put these things into place, like making sure my money is invested for the long term, if it is indeed a long term, that's the stuff that when you get there, you're like, oh, yeah, I'm pretty good at the moment. Like things have my money's been growing, you know. But whereas I see people that come to me and, oh, yeah, I want to retire in 2 years. How? You can't afford it because you've not thought about this until now.
So everyone listening, sit down, log into your super fund, have a look, make sure it's what you want.
Well, I think there's an interesting checklist forming in my head. And when we started this episode, future-proofing yourself in my mind was insurance and what if I get divorced? They were the two things. But I think there's an overarching thing of estate planning now, superannuation, making sure that is in the right setting, and the insurance, which goes across all of these scenarios. Yeah, so putting that checklist together, once again, coming back to our favourite little checklist, Siobhan, for yourself from a financial advising point of view, is it so sit down, bang, check out your super, see what setting you're actually in. See if you can be making contributions and so as well to it, potentially, you know, increase that. There you go. You're all set.
Bloody flying now. I'll be fine now.
No dramas now.
Your 60-year-old self will be like, damn.
That's right.
Good work.
Well done, 41-year-old Phoebe.
But then it's never too early to go to an estate. I thought estate planning was something that I'd maybe be doing in my 80s.
Yeah. I would definitely be going earlier than that. Look, I mean, there's different schools of thought on this, and you would have, I'm sure that an estate planning specialist sitting in this room would be like, when you're 18, go get a will. I appreciate if that's not the priority at that point in time, but certainly when you have children or when you have, an asset base like houses and investments and things like that. And now those two don't have to happen together, but definitely when you have children, you should have estate planning in place. And likely you should also have that when you have an investment base. And if you have both, go get a will.
Look out.
And then finally, insurances. So seeing if life insurance is appropriate for you. TPD may or may not be appropriate for you. Or as you were saying, I was a bit shocked that's the least paid out one.
Yeah, well, statistically, you're far less likely to be disabled to the point where you can never work again versus having an accident where you need several months off work or being diagnosed with cancer or a heart attack. It's just statistically a lot less common. Doesn't make it less important, of course, but it's just a less common scenario. Yeah.
Excellent. Well, once again, Siobhan, thanks heaps for joining us. This has been an enlightening episode.
It was a good one.
Thank you.
Thank you for sharing as well, PK.
Oh, God, that's all right. I want everybody to not make that mistake.
Yeah, get out there, be like PK, log into your super, and make sure you're happy with the setting.
So it's your money. You got to look after it.
No one cares more about your money than you. So
absolutely right.
Awesome. Thanks, guys. And thanks, everyone, for joining us. And we'll catch you next time.
Thanks, Mitch. Thanks, Siobhan.
Thanks, guys.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.